What's up, everybody? Welcome to the Stocks channel. My name is Cory, and in tonight's episode I'm doing another stock market technical analysis update. But before we get into the charts, I wanted to take a second to thank all of my followers and all of my subscribers. I appreciate each and every one of you, and I appreciate all of your recent comments in the comment section down below. And I also appreciate you smashing that like button to help me out. So if you are new to the channel and you haven't yet subscribed to the channel, go ahead and do that now so you can follow along with all of my technical analysis updates. Now first up, we have the ticker symbol SPY, which is the SP500 ETF. So let's go ahead and crack open this chart and see what's going on in the stock market today. Alright, so we see with today's price action on the SPY ETF that we closed down negative 2.32%. So overall, another very bearish day to add to our very bearish trend that we've been observing. So if you are new to the channel, first of all, welcome, and I do want you to know that we are fully expecting this ABC correction, which is a greater correction to this large-scale bull market, and we have no reason right now to believe otherwise. So right now, after we find the end of the C wave down for our correction, we are looking to see if we're going to get a resumption of that bull market to the upside. However, we do have to acknowledge that the price action and the trend are very bearish right now, and we don't want to make any assumptions that this market is definitely going to go back into a bull market. We're going to let the price action and we're going to let the technical trend tell us when this trend reverses from bearish to bullish, and then we will make our assessment of the market then. But right now we see that the price action still closing below the 5 EMA, and we're still trading below that 50 EMA, with that 5 EMA still aggressively heading to the negative side and trading below the 50 EMA as well. So overall, this trend has turned from bearish to very bearish, and we still see evidence that the trend is strengthening in the bearish direction because we see this 20 simple moving average rolling over and going negative and heading down to the downside. So as long as we have bearish price action and bearish trends, we are going to remain bearish, and we're going to protect our capital by not going long on this market and not becoming a bull until we see this trend reverse. So right now we see that our close today was right at an important level, and we also closed right at the bottom of the Bollinger Band. So we can see the price action a little better if we jump over here to a 1 hour chart. And we do see with today's price action that we did bounce off this support level and we came back into this resistance level. And we know this level is resistance because it acted as support back here, and it also acted as resistance right here. So we were fully watching this level at $331 today, and we did see another resistance rejection and the price action heading lower yet again. So that $331 level is still being resistance, and it's driving the S&P 500 into a lower high and a lower low situation, which is definitely the signs that we're in a bearish downward trend. So remember, in order to see this trend start to show evidence of a reversal, we really need to come out here and we need to form a higher high and a higher low. So what that would look like is potentially bouncing off the support level at 323. And if we do start to bounce, we want to see the price action break above 331. And then we also want to see a higher low formed and continuation of that pattern to let us know, at least on the 1 hour chart, that we're starting to see a reversal in this trend. Now that higher high and that higher low would tell us to start looking out for a trend reversal, and that would be our first indication that we may have seen the end of this correction. But right now we're not yet seeing that, and we're still seeing lower highs cultivating as well as lower lows. And if we do see a breakdown of the support level, I would fully expect to see another lower high form and continue to the downside. That's what happens in bearish trends. We form those lower highs and those lower lows, and we're not going to see this trend reverse until we see something different happen with these lower highs. So right now, you need to watch this level as support at 322, and if we start to close below that on the hourly chart with tomorrow's price action, we know we're not out of the bearish trend just yet, and we're still going to see lower prices. So jumping back to the daily chart, what exactly are those lower prices that we're looking for? Well, we did break down below our support level at the 0.618 Fibonacci and also the 0.236 on the larger bull market retracement. So that now has our eyes set on the 315 level, which is the 1x Fibonacci extension of this A move to the downside. So we project that from the top of the B wave to try to predict where the end of the C wave of this correction will be. And we also do see that this Fibonacci retracement level is also a critical support level back here when we did have that gap on that island reversal. So there's a lot of price action and price history in this $315 range. And right now, I'm going to give benefit of the doubt that we're going to get down here and get into this $315 range. Now, if we do get to the $315 and we cut through it like a hot knife through butter as if it weren't even there, that's going to set our eyes back on this $305 level, which is the 0.382 Fibonacci retracement of the bull rally. So we have two price targets that we're watching, the first being at 315, and if that does break down and we get a close below that, we're then looking at 305. Now keep in mind, on the way down, we could still see technical bounces where we go down, see a bounce, and then continue down, and then ultimately see bounces as we continue down, and we could keep walking down in this bearish trend with those lower highs and those lower lows. So that's why I said you have to remain cautious and you have to acknowledge the fact that we're in a bearish trend right now. And as long as we're in a bearish trend, we don't want to try to call the bottom. It's the exact same as when we're in a bull market, how we don't want to try to call the top. Let's let the price action and let's let the technical analysis tell us when this trend reverses. And that way we're not just guessing and trying to catch a falling knife. So right now, as a trader with this volatile times, there's very good chance you can catch these support levels for nice trades. And you have to acknowledge that these support levels are where you want to set your stop loss below in any event that we get a bounce. It's possible if you set your stop loss below support level after a bounce that we never actually come back down and you never actually get stopped out of your position. But in the event that you are wrong and we do come back down and cut through these support levels, you will get stopped out and you will have that capital ready for the next opportunity and the next bounce off of another support level. So eventually the stock market is going to find support and we are going to see a bounce. But like I said, we don't want to try to call a bottom. We're going to watch the price action and we're going to watch the technicals, and we're going to let the technicals and the price action let us know when the bottom is in. So we do see selling volume increasing on a down day. And remember, that's exactly what the big money wants to do. They want to sell their positions into strength. So they're going to let the market bounce on days like yesterday on that lower volume, which tells us that the big money wasn't buying. And we see the volume increasing on a day like today where we're down over 2% because we see that big money starting to sell again. So this trend is completely consistent with our theory that the big money is trying to exit their stock positions, and there's no evidence that that big money, aka that smart money, is trying to buy back into stocks. So with that being said, if the smart money is not trying to buy back into stocks, you should not feel like you're going to miss out and FOMO into stocks at this point, because the big money drives the market. When the big money's selling, you don't necessarily want to be buying in and putting your whole entire position on a long position on the stock market. When the big money's running for the door, it's only a matter of time before the retail investors start running for the door. And that's when we could really start to see those volatility pick up and those minus 4 to 5% days in the stock market again. So just to be very clear, it is completely possible that we get back down to SPY levels of 300, and this 1.618 Fibonacci extension gets us all the way down to about 298. Now, there's no guarantee we will get down there, but it is a high probability chance that if we continue in this bear market that we're going to see those price levels before smart money, aka that big money, finally decides that the stock market is fairly valued and they want to buy back in. So as retail investors, we're way better off following that smart money, and let's follow the price action because the smart money cannot hide their position sizes. We can see it in the volume and we can see it in the trends. And if we can see what the smart money's doing, we can trade and invest just like the smart money. So overall summary of the S&P 500 is we're still in this bearish trend and we still need to be defensive. Next up is the Nasdaq 100, and we're looking at the QQQ ETF or the triple Qs. And we see the Nasdaq 100 closing down minus 3% today. Now we do see the Nasdaq forming a new lower low on a closing price, because back here on September 21st, we were lower intraday, but we did close higher. So overall, we're still seeing bearish price action on the Nasdaq 100, but we are not yet trading at the bottom of the Bollinger Band. Now we still have a very bearish trend on the Nasdaq 100, closing down below the 5 EMA as well as down below the 50 EMA. And we also see that 20 simple moving average sloping negative. So on the Nasdaq 100, there's still a possibility we come down into this 0.618 and find support and bounce, which is at that $259 level. And if we do break down below that support, we have other support levels here at $250 and at $245. So let's take a quick look at the Nasdaq 100 on a 1 hour chart. And we do see lower highs cultivating as well as lower lows. So overall, we still see a bearish trend, and we need to watch tomorrow's price action to see if we're going to come down into this $260 level and bounce and ultimately start reversing this trend, or if we are going to come down and form a new lower low and close near or below this 0.618 Fibonacci retracement level at $259. So it's very clear on a 1 hour chart, if you zoom out, that we're in a very bearish downward trend right now, and you should be in no hurry to be buying tech stocks because there's no guarantee that we're close to the bottom just yet. So going back to a daily chart, you could see here in the grand scheme of the bull market, this could still just be that ABC correction. And we could come down in this 259 level and see a bounce, but we'll see it in the price action and we'll see it in the technicals. and we'll know when the time to go long on the stock market is back. But right now we have to acknowledge it is not time to be buying stocks for a long position. Next up is the Dow Jones, and we're looking at the DIA ETF. And we see that the Dow Jones had another bad day today, closing down minus 1.9%. Now the Dow Jones is still pretty simple for me because I think we're going to come down here in this ABC correction and close this gap down at $264. And that would get us right about a 1x Fibonacci retracement as well as the 0.236 on the greater bull rally. So on the Dow Jones, I would expect to see a nice bounce off of 264. But remember, just because we get a bounce on the Dow Jones doesn't mean we're out of this bear market, because we could still come up here, find resistance, get a lower high, and continue down and form another lower low and continue that bearish market that we're in. So in any event that the gap is not the bottom on the Dow Jones, we do have another Fibonacci extension level at 1.618 down at $255. But right now I'm giving full benefit of the doubt to the Dow Jones closing this gap at 264. So look out for the $264 to $266 level for support on the DIA ETF. Next up is the VIX, which is our fear indicator. And we do see that the VIX bounced right off of support today, right on cue. We saw the VIX in a bull market come back down, test support, and we saw all these moving averages bunching up in this area, which forms a high confluence area where that level is now a very strong support level because all of those moving averages are bunched up together and they're all acting as support simultaneously. So with that being said, I fully expect to see follow through with the VIX. And let's see if the VIX can get back up in here into the 30s. And if it does, we would expect to see those very volatile days. So on a day like today where we're selling off minus 2 to 3%, as the VIX elevates, we're going to expect to see that escalate, and we could see minus 4 to 5% days in a single trading session. So right now, that's why I have to say that you need to remain cautious and you need to protect your capital, because if you're going long too early, there's still a lot more potential downside in this market, and you don't want to get caught in a long position as the market is selling off. So be patient and trust the process. Remember that September is considered a correction month, and we've been saying that here on the Stocks channel since the month began and we started to see this sell-off. Let the month play out and let's see where the price action goes. And if you're not sure what to do, you're probably better off just doing absolutely nothing. And let's wait for that clarity and let's wait for that trend reversal before we ultimately go long on this market and become a bull. Now, I also don't recommend shorting, especially if you're an inexperienced trader, because shorting is not as easy as going long, because typically speaking, the stock market goes up more than it goes down. So the stock market is biased to the long position. And just because we're in a bear market doesn't mean you should be over leveraging on short positions, because that is equally as dangerous as catching the falling knife. So let's take a quick look at the sectors driving this market. And first up is financials. And we see yet again more bad news with financials, with the financials closing down over minus 2% today. So the financials are no doubt in a bear market because we have these lower highs and these lower lows. And remember what I said, the financials being in a bear market is almost a guarantee that the stock market is going to continue to correct, and we're not going to expect to see new all-time highs anytime soon if the financial market is sitting in a bear market and downtrending. So we see that that 5 EMA is very negatively sloping and that the price is basically in free fall on the financial market. And we see that the 13 EMA has now crossed below the 50 moving average, and the 20 simple moving average is becoming more negative. So very bad news for the financial sector, and that is overall very bad news for the stock market. Next up is the industrial sector, and we see industrial selling off minus 1.79% and closing below the 50 moving average today. So overall, still very bearish price action on the industrials, and we did see the industrials holding up the strongest. But ever since they double topped and they came back up to this resistance level and broke down below the neckline, we have to look out for the potential to come down here and close this gap at $72 on the industrials. So very bearish price action with the 5 EMA below the 13 and a close below the 50 EMA. We have to still say that the industrials are in a bear market. Next up is healthcare, and we see healthcare with a very similar story, closing down lower and also confirming a lower price action, as well as a trend strengthening to the downside with that 13 EMA crossing below the 50 EMA and that negative sloping 20 simple moving average. So remember, this could still be that ABC correction, and we could eventually find a bottom and bounce and head back to the upside, but we're going to see that reversal in the price action in the technicals, and we're not yet there. So don't be impatient, wait for that reversal, and ultimately we will know when to buy back into the stock market. Next up is the US dollar, and we're looking at DXY here, and we see the dollar confirming more strength today, closing back above the 50 EMA for the second day in a row. We see that 5 EMA breaking back above the 13 EMA and getting ready to cross back above the 50 EMA. So overall, the dollar looks like it's going back into that bull market, After this very long sell-off, we're finally seeing the dollar find that bottom and start finding strength again. So just a quick recap, while the dollar was weakening, we expected asset prices to inflate and we saw the stock market running higher. And now that the dollar is strengthening and heading higher, we expect to see the stock market start correcting and heading lower. This makes sense because as the dollar weakens, it has less buying power and we expect to see asset prices inflate because of that. And now that the dollar is strengthening, we expect the exact opposite because of the inverse correlation. And now we expect to see the stock market correct a little bit and see those valuations come back to something a little more normal. So right now it looks like there's no sign of the dollar slowing, and we did add this support trend line. So we could see the dollar come back down to the support trend line and continue higher. And that will tell us that this bull trend is staying intact. As long as we're getting those higher highs and those higher lows, we're going to expect the stock market to continue to correct. Next up is gold. And as you know, if the dollar is going higher, we don't expect gold going higher, and we see gold closing lower and lower as the dollar strengthens. So remember, we broke down below that 1900 support level on gold, which brings us all the way down to the 1800 level for the next support. So right now I would be patient on buying gold, and let's see gold come down into the 1800s before ultimately being a buyer of gold and seeing if that support level holds up. Next up is Apple, which is a market moving stock, and we see Apple closing down -4% today and going back below the 50 EMA. We also see the price action on Apple closing back below the 5 EMA, and we still see this very bearish trend with the 5 EMA still trading below the 13 EMA as well as crossing down below the 50. So on Apple, it's almost as clear as day that the bears are coming down for this gap, and look for Apple to get down to $96 before ultimately finding support and then potentially resuming its bull market. Next up is Tesla, and I like to call this our FOMO stock because of all the dumb money chasing it. And we do see Tesla breaking down below its 20 simple moving average, which tells us that that bull market was a fake out and there was no follow through on the buying. So right now on Tesla, it looks like we're still back into that ABC correction, albeit that B wave did bounce pretty high and we did look like we were reversing very quickly. We now know that that was a false breakout on the B wave, and now we're heading down for a correction to finish out the C wave. Now we have to give benefit of the doubt to Tesla potentially holding up support at the 50 EMA here, and that would bring us down to a price level of 360s or down to this 0.618 Fibonacci retracement of 355. If we do break down below that, I would say look out for the 280s price targets because those are where the price action is going to have that full ABC correction. And even if this market is bullish, it's still completely healthy and normal for a stock to go through this sort of correction before resuming its bull run. So just remember, there's a lot of retail investors in Tesla stock, especially since the split in fractional shares with Robinhood investors. And there is a lot of dumb money in this stock, which means that this stock could sell off very heavily in any event that those retail investors get panicked and start running for the door. So next up is Bitcoin, and here we are right back at support level at that $10,200, and Bitcoin is not looking like it had any follow through on its bounce to the bull side. Now this is most likely due to the general sell-off in the stock market and the strength of the US dollar, but if we're a bull on Bitcoin, we need to see it hold up at the support level or at least hold up on the support trend down here at $9,800. So right now I'd say Bitcoin's a hold. I wouldn't be dying to get into it right now. Let's wait to see if it can bounce off this support level and come back up and take out this previous high at $11,000. So to summarize this all up, on the S&P 500, we did add this resistance trend line. In any event that we start bouncing and forming new higher highs and higher lows, and we can break back above these resistance levels as well as these downward trend lines, we could become bullish back on this market, and we could say that this ABC correction has came to an end. But right now we have to trade with what's in front of us, and we're not making any guesses and we're not going to speculate. We see that the price action and the trend are bearish. Therefore, we remain bearish and we remain cautious with our capital, and we're not begging to get back into stocks until we see something start to change in the market. So thanks for watching, everybody. Please remember to smash that like button to help me out. I really hope these videos are helping you out. And if you're new to the channel and want to follow along with my technical analysis, remember to subscribe to the channel. Thanks for watching, everybody. And as always, I will see you in the next episode.